This video is a Transamerica insurance review, more specifically a review of the Financial Foundation Index Universal Life, or IUL for short. So the Financial Foundation IUL by Transamerica. So I'm going to dig into the pros and the cons, what's good, what's not good about this product. I am not getting into whether or not an IUL is good or bad, because that totally depends on the company and the design, but this is more specifically on the product. Now, I do have a little bit of an issue of the people promoting Transamerica's IUL, and it's usually, you probably heard this from WFG Agent or World Financial Group, that sort, and I do also have an issue, which I'll explain near the end of this video. But I want to dig into the pros and cons specifically of this product. So let's dig in. So let's talk about the good, because we got to give it credit where credit's due. They do have strong financial ratings. So if we want to look at the Comdex ratings, which is usually a compilation of all the four review companies, so they all tend to give a lot of A's out there. So where do they really fall in comparison to the other companies? And I talk about the disparity of rating companies in my report, 6 Things Agents Don't Tell You About Index Universal Life, and feel free to download that report too. But Comdex at least gives you a bearing of where it falls in comparison to other companies. So the Comdex level on the Transamerica is pretty strong. It's very high. It's a very good financial rating. So you see that Transamerica Life Insurance gets A's across the board. So like everybody gets A's. They get a 91. And you can see even further down, everybody still gets A's, but they're at 77. So the Comdex score really siphons out who the higher A's versus the lower A's, right? So that's a good thing. So good on them. They're a strong financial company. Nothing wrong with them financially. Let's talk about the red flags, all right? So red flag number 1, it is actually one of the most expensive IULs on the market. So if you would do a breakdown, if you ever do an illustration of the numbers, get the breakdown of the fees. Now, I actually had a hard time getting this from somebody. They sent me one of the most complicated fee breakdowns that I've seen. And you had to basically take a calculator, and even if you knew how to calculate it, you basically had to be an insurance mortality table expert to figure out what actually the fees were. But I finally got a clearer fee chart, and the fee breakdown is very high compared to most other index universal lives. So that's huge. So it's getting high performance, but it's also costing you a lot to get that performance. And I'm going to talk about whether or not that's a good thing. The next red flag is they add a 0.72 annual index fee on that's charged 0.06 monthly to your account. So usually you're credited on your index accounts point to point, which is year to year. So every year it's compounding, only on an annual basis. But this charge is happening incrementally every month throughout that whole year. Don't like that. And they don't give you the option. Some companies have this asset fee on just maybe 1 or 2 indexes. Maybe they're super high performing, no cap option. This has it on even the S&P 500. No matter what you get, you're going to get a 0.72 asset fee. And what's really strange is it's not on the illustration. At least the one I just recently got, you don't see an index asset fee anywhere. I even talked to one of their so-called wholesalers, and he couldn't find it either. Okay, it's not on the illustration, but I do see it on the brochure. 0.06 or 0.72 annually, taking on the monthly policy date through age 20, prorated by account value, then prorated across segments within each account. So it's there, and it's being calculated, but you don't get any notice of it in the illustration, which seems a little sketch to me. So the next thing let's talk about, it is only the 25th best performer on a cash value basis, basically taking income and giving cash value over a period of time. It is the 25th best performer. So now we get into the nuts and bolts of this. So if it is the 3rd most expensive, you'd think it would be the 3rd best performer, one of the top performers. If I'm paying a lot in fees, because what they're doing is they're buying more options with those fees that they're taking. And so you think there would be better performance, or at least better potential. There is a little bit better potential, but overall it's shown that the performance of this is it's very mediocre, if not on the bottom portion of the list. There's about 40 big top players, IUL, Index Universal Life insurance carriers out there. I wouldn't say all of them are top, but there's about 40 that are pretty well known. And I mean, to be 25th and be the third most expensive and 25th best performer, not really getting a good bang for your buck, in my opinion. But the big deal breaker for me when a company happens is this, is when they have a history of raising policy costs on previously issued policies. This is huge. That means I can't trust you. Can you entrust any insurance company or any firm that, once you become a client, you're a customer? And that's the thing with insurance is different from investments. Investments, I can just pull it out and switch it anytime I want to. It doesn't matter on age, health, or whatever. But with insurance, you're investing all these dollars. You got surrender charges. It's a bit more of like a marriage, right? Because once you get locked in, right, you're locking in your health. And if you invest, you're investing your health sometimes as just as big of an investment as your money. You get invested with this company 20 years from now, you can't, and they change the cost of this, you might not be able to qualify for another company. Or if so, it's much more expensive, right? So that just puts you in a bad position. So picking the right company that you're going to invest your health with and your dollars, you want to get the right one. Hardly any of them change their fees. And I know this is the big objection whole life people have of Index Universal Life or people that it's just a big objection is that they can change the fees at any time. Yes, they can. They have to have some leeway because there's a lot of levers in Index Universal Life. But what that is, but most of the big players do not do this, okay? They do not change the fees as long as they're 100-year-old companies. So that's huge. So deal breaker number 2. Right? So they got 2 deal breakers, not just one, they got 2 deal breakers. That's rough, right? No variable loans. You gotta be kidding me. There's no variable loans in this IUL. Okay, so let me tell you a little bit of something. And we're gonna dig into why variable loans is so huge in this video. But variable loans is probably the biggest feature outside of the tax advantage money growth and the fact that you can't lose money. Outside of those 2 things, I would think variable loans is a huge third or right up there with the top 2 of those categories, right? If you don't have variable loans, I wouldn't do an Index Universal Life. I'd go do whole life. I'd go do something else. Variable loans, once I explain it to you, you'll see how big of an advantage and a benefit that is to you by having variable loan policy. Okay, so let's dig in how variable loans work, because some of you are like, well, I don't really care about variable loan. What's that mean? And I understand. So we're going to dig in and explain exactly what is a variable loan. All right, so I'm going to use the analogy of real estate so you can kind of get it. So if you have a home or invest in real estate, this is really going to help you out to understand variable loan. So I ran an illustration for Transamerica, and I compared it to one of the cheapest Index Universal Life out there. So I ran it at a male age 40 standard rating, contributes at $12,000 a year for the next 25 years. So that would be to age 65. That would be a net of $300,000 contribution over those 25 years. So with the Transamerica Financial Foundation Index Universal Life, or IUL, is illustrated at 7.75 as their max illustrated rate, so you can't illustrate it any higher. And the total cash flow from age 66 through 100 would have been a grand total of $1,543,955. Okay, I think it was like around $44,000 a year for those 35 years. So not bad. That's a good chunk. You put in $300,000 and over your lifetime you get 1.5. So that's going to show you the power of IUL. Now this IUL is designed optimally as it could be, even with an inferior product that I believe Transamerica's IUL is. So we compare it to one of the top 3 cheapest IUL. I'm not going to put the name on there because I'm not just making an endorsement for this company. I think there's actually a couple companies that are actually better than this company, but it is one of the cheapest ones, so I'm just going to use it in comparison. So I illustrated this company at only 6%. I think their illustration rate is quite a bit higher for their max, but I just wanted to really show you guys the differences in how the fees and the variable loans rates affecting the cash flow of the Transamerica IUL. So illustrated at only 6%. Total cash flow, same difference, 35 years. So the cash flow generated from this cheap IUL was $1,695,365. So And then again, the illustration rate is a big disparity here, huge disparity. So that's actually a 29% difference in illustration rate. So even though the Transamerica IUL is illustrated at 29% higher illustration because of the higher caps and all that stuff that goes, so it gets a higher potential, it's still getting 9.8% cash flow. So you think it would be all things equal, it would definitely outperform because it's charging more. But even though because it's charging more, because of the fact it is one of the most expensive index universal life policies in the market, combine that with the fact that there's no variable loan option with the policy, you get a policy that performs really poorly. But the cons is it's the third most expensive IUL. You have to have good performance because if you don't, your policy is going to get eaten away with the fees inside of it. That's the problem with this policy. And that asset charge, I mean, you're going to get tacked on top of that cap, so you might as well reduce that cap by 0.75, 0.72 on on all the caps because you're getting charged this ass fee. It's up the ass. It is an ass fee. Anyway, asset fee, yeah. So it is an asset fee that's going to be charged every year, right? And it's actually charged on a monthly basis. Altering issued policy costs, that's my deal breaker. Sad face, get away, get away. No variable loan option. Oh my God, how do you? 25th best cash flow, 25th best in cash flow performance. Again, why are you so expensive? Like I expect more performance, but it's not there. I'm not even gonna give this a little, I do not recommend this product conclusion. I'm giving this a, go run the other way when you see this coming at you. When you see a WFG, World Financial Group agent running at your door trying to pitch to you an index universal life from Transamerica, just tell them, no thank you. I will pass up. Well, guess what? The agents that are coming from World Financial Group or WFG, guess what? They have no idea, first of all, that their product is inferior, right? They just look at the caps. They see the things that are on the front parts of the brochure. It looks pretty and nice until you get in under the hood and know how to look at an engine and drive a real car, right? Until you look under it and you see, okay, oh, the fees are way more. Oh, the cash performance is really not that good. And why? Why is that? Why? Variable loans? What is that? Most of them have no idea. And another thing to add, they're selling these based on the commission that they would make. So they're designing them with high commissions, with high death benefit, more than you need. Especially if they're trying to do it for cash flow, it's going to be inferior cash flow design, and so it's not going to perform the way you want it because they're designing it so they can get more commission from them because they're getting paid based on the amount of death benefit they sell, not on the cash flow they give you. So you want somebody that's looking out for you and for your best benefit.
So this isn't going to take very long, and I think you'll see why. It's because I don't have a ton of good things to say. In fact, I have no good things to say about this particular product. So I'm just going to highlight the things that I find concerning, and we're just going to leave it at that. So this is the Transamerica Indexed Universal Life Review. Now this is, I would say, a relatively unbiased review. I'm licensed and able to sell Transamerica, and I choose not to for several reasons. And let's just go ahead and get into some of those right off the bat. So the first thing that I want to key in on are the actual policy fees as it relates to the Transamerica Indexed Universal Life. The first thing that I want to key in on, and really you can listen to this kind of bullet point and you can stop the video after this if you want to, because Transamerica is one of 3 companies. Now I'm recording this at the end of 2018. So if you're watching this in the future, things might have changed. But as of right now, they're one of 3 companies to have ever increased their fees on their universal life insurance policies. To me, this is the absolute biggest red flag that could possibly exist when you're purchasing a universal life insurance contract. If a carrier has ever increased their actual cost of insurance charges, I'm not talking about rider charges, I'm not talking about things like long-term care charges, I'm talking about cost of insurance as it relates to a universal life insurance contract. They're one of 3, and I would stay away from all three of those companies. Transamerica happens to be one of them. In the same vein, they have a specific charge on their most popular policy that I just absolutely hate. Okay, and it's called an indexed account monthly charge. This fee is ongoing. It lasts forever until the client turns 121 years old, and it just so happens to be one of the most expensive individual charges in the entire industry. Now, I'm not talking about just the idea of this index account monthly charge. I'm talking about the actual charge that Transamerica has on their most popular product. It's called an indexed account monthly charge. It is one of the most expensive charges on any universal life insurance contract in the entire industry, and it lasts for the life of the contract. I hate that about the product. The next thing that I really don't like about this Transamerica Index Universal Life are their loan provisions. Most index universal life insurance policies have several loan provisions that give you the flexibility to determine exactly how you want to utilize your policy. And that's really helpful because not everybody has the exact same objective with their policy. So flexibility is huge. Well, Transamerica has virtually no flexibility when it comes to their loan provisions. They only provide to you fixed loans. And what I did is I went ahead and I copy and pasted their loan provisions from their policy. It's in quotes here on the screen, and I'll read it to you. The maximum loan interest rate on an outstanding loan balance is 3%, with a maximum preferred rate of 2.25%. So stop right there. You might say those charges are different, so there's more than one option. Well, not really. It's the same option. What they charge you to access your money changes based on when you access it. And that's actually pretty standard for just about every index universal life insurance policy that's out there. Typically, the time frame is inside the first 10 years, they're going to charge you, in this case, 3. After the first 10 years, they're going to charge you, in this case, 2.25. So they reward the people that stick around longer. That is standard. Charged in arrears. The preferred interest rate is charged on amounts in excess of premiums paid, less withdrawals and outstanding loans, including interest. Preferred rates are available after the 10th policy year, like I just said. Okay, so the upshot there is as soon as you take a loan on this particular policy, the money that you've loaned yourself stops earning interest. It stops earning interest because what they're going to do is they're going to charge you, let's say inside the first 10 years, they're going to charge you 3%, and you're going to earn, let's say, 2.25%. So that's negative. You're actually losing money in that scenario. 75 basis points a year is a cost to you because they're charging you 3, you're earning 2.25. After the first 10 policy years, the loan automatically becomes what's called a wash loan, meaning they charge you 2.25 and they credit you 2.25. 2.25, nets out to 0. So as soon as you start taking loans on this policy, you stop earning interest on that money. That's not to say that that's necessarily a bad thing. Some people love these loans. The problem here is that you have no other options. There is no flexibility. There are better loan provisions that actually allow you to loan the money to yourself while you continue to earn interest on it. So having that added flexibility is huge, in my opinion, in this policy. You don't have it. The last thing I'm going to talk about is their agency force. Now, this is going to get me killed, specifically because their largest agency force is really active on YouTube. And I actually get a lot of views from their agency force. But I don't care. I'm gonna burn the bridge because I think it needs to be done. So their biggest, or one of their biggest distributors, is a company or a group of agents called WFG, World Financial Group. In my experience, WFG reps are some of the most, if not the most, uneducated insurance and annuity reps in the entire industry. And I've seen hundreds and hundreds of WFG reps. My experience has been they know how to sell the products, but they don't know how to design them. They almost is the key word, they almost exclusively sell Transamerica. And the reason that they almost exclusively sell Transamerica is because Transamerica pays WFG more than the other carriers do. So that seems like a little bit of a conflict of interest in my mind. So WFG gets paid more by Transamerica, therefore WFG reps write almost exclusively Transamerica. They know how to sell the products, but they don't know how to design the products. And most oftentimes, the products are sold in a way that generates the maximum commission for the WFG rep. It's not designed to accumulate the maximum amount of cash for the client, which is how it should be done. It's sold to generate a big commission. And it's not necessarily that every single WFG rep is bad. I'm sure there are some good ones. I just haven't seen any of them. So that's probably going to get me killed on YouTube, but I don't really care. It's true in my experience. The WFG agency force sells this product a lot. They push it a lot. It's a bad product. It's not anywhere near the top 5, not anywhere near the top 5. And there are much better options out there.